Welcome to the deep dive. Today, we're taking a really close look at how a financial giant basically rebuilds its whole business model. We are cracking open Morgan Stanley's 2016 shareholder letter. And this thing isn't just a look back at the year before. No, it's more like the blueprint for a massive strategic shift, one they spent, 6 years putting into place. Our mission here is to really understand the huge choices leadership made, how they realigned their capital, their business mix, even their whole corporate culture, all reacting to those massive regulatory changes after the 2008 crisis. This letter kind of marks the finish line for that big effort, or so they claimed.
Yeah, it's a fascinating document, actually,
Yeah.
because it pulls together years of, frankly, pretty painful repositioning. And the context they give is that it comes after a mixed year in 2015. Started strong, but then, the second half got difficult. Sudden global economic instability hit them.
Yeah.
But the core strategy underneath, that was set. Structure the firm for consistent, predictable earnings, higher shareholder returns, and crucially, align everything with this new regulatory world.
Okay, let's unpack that structure then, because Morgan Stanley's whole identity, it seems, rests on this idea of diversification. 3 strong pillars, they call it. You've got the world-class institutional side that's investment banking, high-end sales and trading, then combined with a top-tier wealth management business, and also strong investment management. It's this delicate balance they have to strike, right?
Exactly. That's the core tension, isn't it? How do you stay world-class in the institutional game while also prioritizing stability?
Yeah.
And their answer, at least partly, was to lay out very specific, measurable financial targets for 2017. It was about accountability to shareholders. This wasn't just, fluffy corporate speak. It felt like a real line in the sand.
And the big one, the key metric they zeroed in on was return on equity, ROE. They set that target pretty high, actually, at 9% to 11%. But hang on, there's a quick bit of jargon here we should probably clarify. For listeners looking deep into the footnotes, they specify excluding the impact of DVA, what's DVA, and why exclude it.
Good catch. That shows you just how specific these reports get. DVA is debt valuation adjustment. Basically, it's a non-cash accounting item. It reflects changes in the value of the firm's own debt. So weirdly, when the bank's credit quality gets better, DVA creates an accounting loss, makes the ROE look worse than the actual business performance.
Okay, so it's an accounting quirk, not operational performance.
Exactly. So by excluding it, they're saying, look, focus on how our core businesses are actually doing. Forget these technicalities. That 9% to 11% target. That's the clean operational goal they set.
Got it. That makes a lot more sense. So setting that 9% to 11% bar meant they had to be, really precise about where money went and where cuts happened.
Oh, absolutely precise. Surgical, even.
Yeah.
And you see 2 completely different playbooks for their 2 biggest segments. Let's start with the bright spot, the engine for growth, wealth management.
Right. Wealth management was definitely positioned as the anchor of stability. What was the main goal there? Beyond just, keeping the revenue steady.
The focus was really on boosting the profit margin. They knew the growth was happening, but they wanted to make delivering that growth cheaper, more efficient. They hit a record full-year margin of 22% in 2015, which was up from 20% the year before. Nice jump. And their 2017 target, even higher, pushing for 23% to 25%. Hitting that would massively help the whole firm's returns, because wealth management just doesn't eat up as much capital as trading does.
Okay, so how are they actually driving that margin boost? Because the letter points to something that feels a bit counterintuitive for that time. Huge growth in net interest income.
Yeah, they really leaned into a few key things.
Yeah.
First, they dramatically ramped up lending, using their U.S. banks to lend directly to their existing wealthy clients. Get this. Net interest income grew by a stunning 46% in 2015 alone.
Wow, 46%.
Yeah. And NII, that's the difference between what they earn on loans and pay on deposits. Very stable, predictable income stream. So they were kind of pivoting wealth management into a full-service bank for their rich clients.
That 46% II growth, especially in a flat rate world, that really shows an intense focus on cross-selling and just getting deeper with those clients.
Yeah.
They were also hitting 2 other big trends, weren't they? Offering better cash management products to get sticky deposits and really riding that big wave away from old school commission advice towards fee-based managed accounts, which gives them that lovely, predictable, recurring revenue.
Precisely. So wealth management is all about stable growth and margin expansion. Now flip over to the institutional side, and you see the total opposite dynamic in one key area. Investment banking and equity sales, still world-class. Top 3 globally in M&A, IPOs, equity sales and trading, #1 in global revenue market share. These were capital-light winners, very profitable.
Right. But then you hit the problem child. Fixed income in commodity sales and trading, FIC, they call it. That's where the really big, painful cuts landed.
That's exactly where the strategic trade-off happened. FIC was caught in this double squeeze. First, the whole industry pie for fixed income revenue was shrinking.
Yeah.
Just less business to go around. Second, and this is the big one, regulations kept piling on, demanding more and more regulatory capital be tied up just to support market making in bonds and commodities. The whole risk-reward equation just broke.
So basically, they couldn't make enough profit anymore to justify tying up all the capital the regulators were now demanding. Okay, so that's why they restructure. The letter says they cut FIC headcount by 25% right at the end of 2015 and set these super specific low capital targets. Risk-weighted assets under $110 billion, SLR exposure under $250 billion.
Right.
Why those specific numbers? What do they really mean?
Those numbers, RWA and SLR, they're the language of modern bank regulation. Risk-weighted assets, RWA, that helps regulators figure out the minimum capital needed based on risk. And the supplementary leverage ratio, SLR, that's an extra layer. It forces banks to hold capital against all their assets, risky or not. So by setting these hard, low targets for RWA and SLR in the FIC business, Morgan Stanley was basically shouting, we are strategically shrinking the regulatory footprint of this business. They chose stability over volatility there.
Okay, a 25% headcount cut plus those hard caps. That sounds like a permanent step back from a pretty core institutional market, doesn't it? The letter says this move was supposed to free up at least $5 billion in capital. Great. But didn't cutting FIC so hard risk damaging their relationships? Especially since, those connections probably helped their really successful investment banking side. How did they manage that risk?
Well, that was the big strategic risk they took, no doubt about it. They tried to mitigate it, I think, by focusing FIC resources only on areas where they still had clear client advantages and scale, maybe areas closely linked to investment banking deals, for example. And they just walked away from the more volatile, capital-hungry parts of the business. Ultimately, it seems the answer was simply that the regulatory cost, the capital drag, was just too high to justify playing across the full FIC spectrum anymore. That $5 billion in freed up capital. That was the prize for making that really tough choice. #tag3. Firm-wide efficiency, capital, and sustainable investing.
Okay, so shrinking FIC, boosting wealth management, that helps the capital side. But hitting that 9 to 11% ROE target meant the whole firm had to tighten its belt, right? Which brings us to this firm-wide push, Project Streamline.
It's exactly right. Project Streamline was the firm's explicit cost-cutting strategy, totally separate from just shifting the business mix. And the goal was huge, $1 billion from the firm's expense base over 2016 and 2017. Importantly, this wasn't about cutting front office revenue-generating staff. It was more about, structurally simplifying things, consolidating back office processes, using technology better across the whole organization to save money.
And this focus on efficiency seemed to be working already. They mentioned beating a previous target, hitting a 77% firm-wide expense efficiency ratio in 2015. Project Streamline was aiming even lower, for 74% in 2017. What does dropping that ratio by 3 points actually signal to investors?
It signals relentless cost discipline. That ratio, the expense efficiency ratio, basically tells you what percentage of every revenue dollar gets eaten up by operating costs. So dropping it from 77% down to 74% means they plan to keep an extra 3 cents of every single dollar of revenue as profit. For a giant firm like Morgan Stanley, that 3-point swing is massive leverage towards hitting those ROE targets. It shows they're committed to profit through control, not just hoping for market booms.
Right, connects the dots. So if you put it all together, the efficiency drive from Streamline plus the capital freed up from shrinking FIC, that allowed them to really project serious capital strength.
Correct. By taking all these steps on painful reshaping the business, they could really shore up their capital base. They reported, $68 billion in common equity and a $203 billion global liquidity reserve late in 2015. That's a rock-solid foundation. And with that kind of foundation, they could confidently start returning more capital to shareholders.
And return it they did. The dividend went up 50%. The share buyback program jumped massively from $1 billion to $3.1 billion over 5 quarters. They were basically setting up to buy back $2.5 billion a year. That's the direct payoff shareholders finally saw after sticking through those 6 years of restructuring. Now, before we move to culture, there's one other interesting detail. It shows they weren't just reacting to rules and costs, but also to what clients were asking for. This Morgan Stanley Institute of Sustainable Investing.
Yeah, that's a really key signal, I think. They'd launched it 2 years before this letter, and the goal was specifically to weave sustainable investing throughout the whole business. They saw clients, individuals, companies, big institutions, increasingly asking for investment tools that tackled social and environmental issues. So things like green bonds, they're investing with impact platform. It showed they weren't just waiting for regulators. They saw market demand there, a way to differentiate themselves.
It's easy to get lost in the numbers, the balance sheet stuff. But the letter itself really hammers this point. Culture drives long-term performance, especially when markets get choppy, like they did in late 2015.
Mhm. The emphasis on culture here, it's almost philosophical, isn't it? They list their 4 core values going way back to 1935. Clients first, lead with ideas, do the right thing, give back. And they present these as the bedrock, the anchor that let them navigate this huge transformation without, losing who they were.
Yeah.
They also explicitly stress needing open dialogue, where people can actually identify and talk about risks honestly, which of course is critical after the kind of failures that led to the financial crisis in the first place.
And culture needs leadership to make it stick. They highlighted some changes at the top, notably appointing Colm Kelleher as president of the whole firm. He was tasked with overseeing both institutional securities and wealth management. What was the strategic thinking behind putting those two very different businesses under one leader?
Yeah, that was a big move. The main goal, pretty clearly, was to force collaboration. Historically, the Wall Street trading arm and the wealth management brokerage arm often operate in their own silos, kind of different worlds. Putting Kelleher over both was a signal from the top: work together, make sure the institutional powerhouse supports the wealth clients, and maybe find ways wealth management insights help the institutional side. It was a structural move to break down those internal walls and actually realize the potential of that diversified model they kept talking about.
It's also interesting how they use this letter to deliberately connect back to past leaders, framing this huge 2016 transformation as just, the latest successful chapter in a long story of adaptation.
Absolutely. It's an explicit appeal to institutional memory, isn't it?
Hmm.
They bring up Bob Baldwin, who led the firm from 73 to 83. He oversaw that big expansion from just advising into actual securities trading and money management. That was a massive shift back then.
And Parker Gilbert, too. He was chairman when they made that equally huge leap from being a private partnership to a public company in 1986. It feels like they're telling shareholders, look, we've navigated massive changes before. We know how to do this. Trust us.
That's exactly the thread they're pulling. Both those past leaders, the letter implies, really embodied that ideal of doing first-class business in a first-class way. So the message to the current shareholders is kind of this strong culture we've built over decades. That's what gives us the resilience to see this tough strategy through, even if the markets wobble. The culture is the justification for the pain of the restructuring. #outro.
So wrapping this up, what does this all mean for you listening? Well, this 2016 letter, it's really a masterclass in corporate adaptation under pressure. It's a roadmap for how a giant financial firm survives and maybe even thrives in that highly regulated post-crisis world. It's all about strategic capital choices, making those tough cuts in high capital, shrinking areas like FIC, for pouring resources into high-margin, scalable businesses like wealth management. Then layering on firm-wide efficiency with something like Project Streamline. And underpinning it all, relying on that deep-seated, established culture to manage the change.
Yeah, the whole strategy was really an admission, wasn't it, that the post-crisis era demanded a different kind of bank, one that valued stability, consistency, being less capital hungry over just chasing huge trading wins. Their path forward, as they laid it out here, was about using technology for efficiency, grabbing market share in the less volatile businesses, now that, as they saw it, the bulk of the new regulations were finally in place. And it's fascinating how the firm really positions its culture, those values from way back in 1935, as the absolute key to its success over 80 years. So for you, the listener, maybe the interesting question to chew on is this. We're now in an era defined by accelerating technological change, right? AI, massive data shifts, totally new digital finance plumbing. Does that deep commitment to foundational 80-year-old values, that phrase they use, doing first-class business in a first-class way, is that enough resilience for the next wave of disruption? Or will technology itself force an update to those core values? That's something to mull over as we watch how finance continues to evolve.
That is a really provocative thought to end on. Thank you for joining us for this deep dive into Morgan Stanley's strategic blueprint from 2016. We hope this helped accelerate your understanding of how these major financial institutions tackle these huge multi-year transformations. We'll see you next time.